The one thing we wanted to do today, Matt, is talk about how to use a put option and to protect yourself, either in the portfolio or a call or whatever it is. And we wanted to show some of that mechanic. Kind of explain that, if you would.
What I've done here, guys, is basically I'm simulating the environment of last November, right? And what I wanted to do is I wanted to simulate this based on what we talked about yesterday. We talked about yesterday how this was a perfect opportunity to add insurance to a long-term environment, to a long-term portfolio, given the technical condition that we were looking at. And just to kind of show you that very quickly, if we were looking at the S&P 500, we were looking at it on a weekly chart, and you had this little retracement coming back up into here, right? And we said, okay, based on this, we see that hurricane coming at us. It may hit us, it may not, we don't know. We don't know what the future holds for certain, but we do know that the risk has increased, and we do know that when you buy insurance is after retracements. You don't buy insurance when the market is screaming down. And Tim, can you explain to our Team Tackle why we do not buy insurance as it is screaming down?
Because you'll have to pay more.
It's simple.
Our mother and our family, actually, we come from a long history of being insurance, providers. Our family had insurance agency. And imagine, Matt, if you lived in a world where you could buy car insurance whenever you wanted to, instead of having to have it all the time. That's kind of the market. That's what the financial markets are. Yeah. You can add insurance when you choose to, instead of having to carry it. And waiting until it starts going down is like waiting till it snows outside and then calling for car insurance. They're going to make you pay more. The premiums are going to go up because the risk is higher, right? Yeah. So it's just the cost relationship.
It's how insurance works in absolutely everything. Tim, if you have 3 DUIs on your record, which you don't, but if you did have 3 DUIs on your record and you have 14 speeding tickets, and I have 0 DUIs and I have 0 speeding tickets, and I'm a law-abiding citizen, they're going to make you pay more than they're going to make me pay, simply because of probability.
That's right.
If you and I live in South Jordan, Utah, nothing ever happens in South Jordan, Utah. It's a really boring state from a natural disaster perspective. We don't have to pay as much in insurance here in Utah as, say, somebody in Florida does because of hurricanes and that. It's just the way all insurance works. If the probability is greater of risk, insurance premiums go up. And so as the market is coming up, the volatility is going down. So as markets go up, volatility is coming down. As markets go down, volatility typically goes up. As volatility is representative of an option Greek called Vega. So Vega goes up, value of options go up. As Vega goes down, value of options go down. So as the market is screaming down here, the value of those options are increasing. And so you're paying so much in premium because you're the last one to buy insurance. But as the market is coming back up, you're saying everybody in the market's like, oh, it's going to go back up. It's going to go back up. Everything's good. Everything's gravy. Nothing to see here. Just go buy everything. And so the value of options, the value of those put options are decreasing. And so it's at that point where you're like, okay, technically we're now in a bearish retracement. Technically we're coming into that resistance level. So technically speaking, I want to add some insurance, because the most likely scenario isn't the market's going to go straight back up. It's going to come back down, go up, back down, go up. So in terms of this is a perfect opportunity to add insurance to the portfolio. So what I did, T, is I added not 100 shares. I basically simulated 400 shares in the S&P 500, right? So if 400 shares in the S&P 500 is simulating right around, what would that be, 112,000, somewhere around there?
Yeah, 260 times 400. Yeah, a little bit more north of 100K. So
obviously north of
about 110K, right?
Okay, so whatever it is, don't care.
Yeah,
it's 110, 111K. All right.
Well, the BP effect over here says 55.7. Just double that. That's exactly
that. 110 and a half. So we'll just say 110. So basically what I did was I said, okay, I have $110,000 in this retirement plan. In this retirement, could be a 401k, solo 401k, could be a SEP IRA, could be a Roth IRA, could be a traditional IRA. It could be just a margin account that you have long-term investments in, right? So all I've done is simulated a $110,000 portfolio in the S&P 500, which would be very similar to a retirement account that is invested in mutual funds with $110,000. So here's what I'm looking at. technically speaking, okay, we're currently at 278 on the marketplace. It certainly could go back up to 292. So let's go here and we'll say we'll add our price slices. So let's say it goes all the way back up to the current resistance of 292. Just give me a second. Let me change that. So if the market recovered the complete drop T, we would recover back up $5,400. So if the market recovers this entire drop that it had in October and November, and we're getting that snapback rally in early November, you're going to make back $5,000 that you lost in this movement to the downside. So if the market goes down to the next level of resistance, and we knew where that next level of resistance was, is right here at about 260. So if the market goes down to say 260, that next level of resistance, you're going to lose $7,400, right? So if you're looking at that from a trader's perspective, you have an inverted reward to risk ratio. You have more risk than you have return. And technically speaking, you were forming a bearish retracement, which is the probability has to be down to the downside. And we talked about that. If you want to go review our November and October, halftime reports where I called the Russell 2000 bearish in October, go review those. But you were seeing a technical pattern called the bearish retracement. And at that point, Tim, I promise you, we probably said this is a good time to add insurance, the same way we said that yesterday. This is a good time to add insurance. So what I can do here as a trader is I can come out. Now, there's a couple of different ways to do this. If you are that long-term investor, like my mom, my dad, long-term investors, they want to buy insurance for a long time. They just say, okay, I'm going to go buy 500 days worth of insurance. Okay. And there's nothing wrong with that. There's nothing wrong with that. But as a trader, I know the markets don't just go down. They go down, they go up, they go down, they go up, they go down, they go up. So as a trader, I don't need to buy that much insurance in terms of time, because I'm going to close my insurance the next time it comes down into support. Does that make sense?
Mm-hmm.
Okay. So as the market comes down into support and the projection changes, I'm going to uncover, I'm going to unhedge, I'm going to remove the insurance from the equation, because the only thing that I'm protecting here is this next movement to 260. That's the only thing I'm really protecting. Now, can it go under 260? Absolutely. And if it does, I'll be very happy I have that insurance. But I want to cover that next drop down to 260 is what I want to do. And then obviously, if I have the insurance and it breaks that support level, I am very happy I have that insurance already, because I bought insurance at a cheap price up here instead of a very, very high price, as the market is in fact breaking that 260. So what I'm going to do is I'm going to come to the market and I'm going to go down. Now, T, there's a couple different ways you can do this as well. If you're collaring the trade and you're selling 40 delta call options, I would buy 25 delta put options. That's what I would do. If I'm covering from a short-term perspective as a trader, I might go buy an at the money put option. Okay, if I'm covering as a short-term trader. So what I'm going to do is I'm going to come to at the money, current stock price 278. Okay, I'm going to come to 279 here. Now, if you're looking at this on the risk profile, we own 100 shares of the spiders. I'm going to add 4 put options. Okay, I'm just going to have 4 put options. I have 400 shares. I'm going to add 4 put options. Now, what that does is it basically removes some of the gain to the upside. Okay, some people would think about this as a cost. I'm spending $4,000 to protect $110,000. I don't see it that way. I see this as an allocation. I am taking $4,000 of my portfolio and I'm allocating it to protect the 110. So it's like I'm doing a spread here, basically. That's kind of the philosophy, the mindset here. But as you can see, what happened? Well, our return to 292 was going to be 5,400. Our risk was going to be 7,400. By protecting that, all of a sudden, I now have a positive return versus risk. I've given up a couple $1,000s of potential gain, right? I've given up a couple $1,000s of potential gain, but I've covered $5,000 of potential risk to the downside. That's option number one. Option number two, if you wanted to be aggressive in your insurance position, is to basically double your contracts, and that's what we call a ratio type trade. So a ratio trade is when you're buying more than what you typically do. And so a ratio trade basically states that all of a sudden you create this V-shaped risk graph, right? Which means now what you can see, now obviously volatility is going to impact this reward to risk ratio, time will impact this reward to risk ratio, but what you now see is if you get any movement one way or the other, you do have a positive outcome, which means you're taking out the risk. Where you will lose money on this, and you can see you're making $104. That's not accurate, but where you do lose money on this is if the market stays sideways and basically time ticks down out of the insurance you're having. So what I'm going to do is I'm going to ratio this trade. I'm buying 8 put options to protect the 400 shares. And again, you can do this non-ratioed as well, but I'm just showing you the aggressive stance at it. Now we're going to fast forward a little bit in time, just to show as it comes into 260. So going back to the chart here. Now this is where we were at right there. This is where we're at. You have that bearish downtrend coming down on the short-term trend. You're popping back up into that 2,800 on the S&P 500. You're adding insurance based on the fact that it is a bearish retracement. Now, as you can see, the market over the course of the next couple weeks came right back down into that 2,600 level. So here it comes back down into that 2,600 level. You're holding the insurance. You're holding the insurance. You're not going to get rid of it. You're holding the insurance at that point. Okay, and so right here, let's go project that on 1210. So now we're coming into this and we're saying, all right, let's fast forward to 1210 to show you how this works. So we're just going to fast forward to 1210 here. And it takes a little bit to, you can see it up here, pre-buffering. This is the on-demand program through Thinkorswim. So as you see it says on-demand now. Now we're back here. Let's go look at the chart. Okay, so it came down in price. It's hit that 260 mark. And you're saying, okay, my loss was going to be $7,000, Tim. Okay, so now I'm down $4,000. Oh, wait a second. Oh, I didn't actually. See, this is where, Tim, you're going to be like, Matt, listen, you didn't actually add the insurance there, buddy.
On the on-demand. I love this platform, by the way.
It's so good. It really is so good.
Yeah.
11.5. Yeah, I just got to go back to 11.5. I didn't actually add those put options. I'm like, oh, that's not right. I was just showing them on the risk graph. So let's go actually add those put options on the spiders. All right, and we were doing 278, I believe. Actually, we'll do 274 here. Just add them. And we'll play it up. Okay. Now you can see it on the risk graph. And let's take out that one. There we go. Okay, so now we're long 400 shares. We're long 8 put options. We have the March strike price. We have our V-shaped risk graph. Now let's go to the end of that week on the 14th. Now we're cooking there, bro. I forgot to add the ingredient of the put options. It doesn't work if you don't add the put options. So we're pre-buffering here. Okay, now let's go to the monitor tab. Now, I'm down $6,000 on my S&P 500 trade. Kind of what we talked about, what the projection was, right around $7,000, right? So we're down $6,000. But what is our put options done? Our put options have increased by almost $4,500. So we've offset $4,500 of that risk to a net loss of $2,300. That's what that insurance did. Now you have a decision to make. We're approaching that support level here. Do you want to pull the insurance off? You have that decision to make.
Yeah.
It worked how you wanted it to work.
Well, and you do have that simple
Pull it off.
decision, pull it off or not, right? Or you could just unwind half of it, because, or there are a
Okay.
lot of different subtle things you could do. Uh,
I think that what you just said is the best one.
yeah.
And that's why I do like ratioed at first, because that allows you to unwind half the position, right? Lock in profit on half of the position. So
Mhm.
let's go do that. Let's go right click, create a closing order. Let's lock in on half. And I'm not doing any mid price or net. I'm just whatever the price is. Okay, so we locked in half of our position here.
Mhm.
Right now, you see we only have 4 contracts. We locked in half our position. That's done. So if the market does go back up, we locked in profit. We still have half the trade on. So let's fast forward another week.
Mhm.
And let's go to that 20. Let's go to that 24th day. We know what happened on the 24th. Okay, so now you see the market coming down, down, down in the next week. And pre-buffering. All right. So now, Tim, we would have lost $16,000 on the retirement account. In that week, we had another $10,000 in loss on that retirement account. But what did our insurance do? It's up a grand total of $10,000 total.
Mhm.
We've covered a majority of the loss. We've covered $12,000 of the loss. If I would have kept the ratioed on, you would have made money on.
It would have profited.
You would
Yeah.
have profited.
Yeah, for sure. But these are the kind of things, by the way, that you can learn in on demand and in back testing, and you can simulate, and you can go back and you can really think through it and work through it. It's incredible.
The on-demand program is such a good program. It's not a one-to-one, obviously. You know, when you're doing a spread, I mean, it might take some time to get filled, so the fill rates are a little different. But it's a wonderful way for you to go back and test how things would work, right?
Sure.
It's a wonderful way to, and sometimes when I'm like working one-on-one with somebody, I'll simulate an entire 50 trades over the course of a 3-month period, and we'll make decisions day after day after day after day after day. It's just a wonderful environment to practice in. It's a wonderful environment to learn in. It's a wonderful environment to test new ideas, new strategies in, and it simulates a live environment. But that's how the protected put option works.
I love it. And in my opinion, if you can control risk, you can do this forever. And I think that there's not enough training like this right here, Matt, where people talk about how to protect themselves and how to hedge and how to understand market dynamics in that regard. If every investor out there just took the time to learn the protective put and collar, you could trade in your retirement account with much more confidence. So I love it. Very, very good job.
And let me respond to Sam real quick. Sam says, so you're basically saying swing trade the insurance. As a trader who can be aggressive in the marketplace, yes, that's exactly what I'm saying. It would be a swing to position trade, depending on what you're trying to accomplish there. But yes, that would be a swing to position trade. If you're an investor that doesn't have that trader skill set and you just want to protect what you've worked so hard for in that retirement account, I would not swing trade that in any capacity. I want to position trade that. Given the fact that we're at the top of the market cycle in a rising interest rate environment, what I would do is I'd go buy 2 years worth of insurance at a 25 delta is what I would do.
Mm-hmm. A lot of stocks flashing here.
Honestly, I would not touch that insurance. I wouldn't touch it 1 second. I wouldn't try to manage that insurance. I would basically say, if I lose that insurance because the market goes up, I don't care. Let the insurance work. And before you start getting into the, well, Matt, you'll lose money on insurance. Well, guys, you lose money on insurance every month of your life. You don't actually want to use your insurance. You don't actually want to die, so you use your life insurance. You don't actually want your house to burn down so that you get to use your home insurance. You don't want to get in a wreck, so you use your car insurance. You want the insurance there to give you peace of mind. You want insurance there so it takes out risk of hypothetical scenarios. You don't actually want to use your insurance. You want the market to go up. You want your long-term investments to do good. You want to compound cover calls. You want to collect a dividend. You don't want the market to crash, but you will be very happy that if the market does crash, you have that insurance at the top of the market that gives you the ability to sell the market at the high price instead of taking the loss.
Mm-hmm. Oh my, what a day. You know, guys, if you got value out of today, make sure you give us a like and a share here. Obviously, that's really amazing training, very important stuff.